Stocks found themselves in a sea of red today, led by tech shares as more turmoil unravels this failing financial system. The money supply is slowly drying up and the Fed knows it. Their dilemma is only on the surface level. The truth hides just out of sight. Well, that's why you came here for the truth, so let me unveil that for you. Today we are going to look at what has happened in the markets. I want to connect that in with what's going on with the deficits, the Federal Reserve, and so much more. Let's begin by taking a look at these articles from CNBC. Tech stocks painful sell-off dragged into another session on Monday. So it was understood that Monday would be a rise of 1,000 points. I saw that comment several times that we would have a 1,000 point increase today, and that didn't happen. So tomorrow could be a different day. But at the time of this recording on Monday's trading session, it was another down day led by tech shares. FANG stocks, Amazon, Netflix, and Alphabet tumbled by more than 1%, while industry leader Apple fell 2%. So there's some details here, and basically this article tries to suggest that you need to buy more stocks. That is the solution. Many believe inflation will only rise modestly in the balance of this recovery. However, even a moderate acceleration in wage and consumer price inflation towards 3.5 to 4% could produce an outsized and surprisingly aggressive response from the bond market. There are worries that the average person simply is unaware of, and that is the reaction to what will happen with these inflationary pressures. The market doesn't know what inflation is because they haven't felt it in a very long time. Many of the traders today are unaware because their career doesn't even span long enough to know what a little bit of inflation feels like at all. Real estate agents, the same exact issue. Mortgage brokers, and so on. They've been dealing with historically lower and lower and lower interest rates, but hey, they went all the way to the floor. So over the last 10 years, we've seen an unprecedented time. This has never been like this in history. It's just these last 10 years where everything is completely messed up. Nothing makes sense. All of these supposed fundamentals are now thrown out of the window, but eventually that could come back around to bite them in the behind. All right, so both the S&P 500 and the Dow dropped more than 4% last week. The Nasdaq fell 3.7%. The S&P also posted a third consecutive weekly loss, its longest such stretch since June of 2016. Now, this is not the end of the world, of course. This right here just shows us that we will encounter some bumps along the way. Those bumps tend to be small, and then sometimes they're really, really big, but ultimately this is the way it works. There are cycles present. There are always going to be these factors, and that just needs to be understood. That's it. Now, the deficit, to say the least, is just beyond anywhere near a realistic level. U.S. budget deficit expands to $779 billion in fiscal 2018 as spending surges. The spending has gone up, and you know where it's gone to. For the most part, defense, so-called healthcare maybe. But usually that's the way it is. Defense gets the number one priority. It's not actually defense, but that word there is more political. All right, so that connects in with the chart here. Mind the deficit, surplus deficit versus the GDP from 1947 to present, and you will see that the just staggering levels. That we can use their fake GDP numbers all we want, but ultimately when I look at this, I see nothing but deficits. And it gets worse. At the bottom it says here, surge in deficit as spending goes blank check. And that's the way it is. It's not the most that it's ever been, but it's horrendous and it's not going to get any better. You need some sort of deleveraging. It's just the way it is. Now, going back to what we saw in the last week here essentially, but this is as of October 12th, this chart, And it's showing us the S&P returns over the last 5 days, minus 4.1%. Looking at that. I would actually like to see some updated numbers of this. If I can find it, I'll grab those for you. But we can see wherever you look, it's been down. I mean, utilities was down only 1.3%. Go into materials and industrials, even financials, these are above 5 and 6%. Looking at this tells us that in this, if you think about it, in a 5-day period, that is truly worrisome. Even tech down in this case here from this showing us minus 3.8%. This has to turn around quickly or else those traders, those algorithms are going to start to get tripped up. Okay, it is important. Central banks are the reason why the stock market had risen in the first place. You could see this point right here. That's the financial crisis. Ever since then, the escalation, the addition or multiplication of assets to these balance sheets has been off the charts. You could see where it has gone. You see something changing though, right here. And that is liquidity drying up. That is a deleveraging, somewhat. It's too slow as far as I'm concerned. But that just so happens to coincide with the stock market declining. It's too early to tell, but on the way up, they certainly correlated. So we'll see how this goes on the way down. Now, I'm not even talking about US stocks. You can look around the world and see the global stock market. The global stocks are not performing well at all throughout 2018. Currencies are doing terribly this year. Basically all of them. And when you look at this chart here, it needs to be looked at closer for what this could mean for the foreseeable future. If they're not printing any more money or they're slowing down on their money printing, how can we get the growth that we had previously? Global central bank balance sheet growth has been decelerating sharply all year and will go negative on a year-over-year basis by January. That's not good. That's January 2019. So you'll see here on the chart how it's been over the years, going back to 1980. It doesn't matter to me. All I wanted to show you was that when we have these time frames, there can never be a good outcome in terms of, if you think a good outcome is rising assets. It's not going to happen. You can't. There's no possible way. Total system leverage, government, corporate, household, margin banks. And just look, the red line, that's the total system leverage. Look at the S&P 500 stock price index. And, when I see this, obviously there's a correlation there. But to me, it shows what this system is built on. And that leverage, occasionally, it snaps. Okay? On occasion. When it does, the market reacts negatively. Doesn't have to, the amount of leverage in the system, that's not going to stop. There's going to be more people using margin. There's going to be people using all of these different strategies to use less money and leverage it up in some way. New things that are created, derivatives and all these things. I don't know what will be created in the future. Regardless, I do know it's going to mean disaster at some point. It's just the way it is. It's inevitable. Look at this. Assets held by the Fed, and they're making it look more than it is ultimately because the actual decrease has been a few $100 billion. Regardless, they are dropping those off. And then we have the red line, which is the effective federal funds rate. And that has been slowly, way too slowly, been ratcheting up. And eventually, this is going to snap. There's no doubt about it. If they change their mind, it might actually be too late. But if they change their mind, start bringing the interest rates down, maybe they could push it on longer. But if they keep increasing, increasing the interest rates and decreasing the balance sheet, it's a guaranteed, negative impact to the stock market. You might have another central bank coming out there, Swiss National Bank or People's Bank of China, or who knows, that could bail out the market. But if this is the way it's going, it's a simple matter of fact. If you found the video informative, please give me a thumbs up. And give me a thumbs up, it helps to support the channel, so I do appreciate that very much. And if you want the financial education you were not taught in schools, these 2 books have it all. You can check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.